Good afternoon, everyone, and welcome to our webinar today. Our presenter really needs no introduction to those in the dairy world. Mark Stephenson has been a dairy expert for a long time. He's very well regarded and respected. Mark is the Director of Dairy Policy Analysis at the University of Wisconsin-Madison. Mark has a doctorate in agricultural economics at Cornell University, where he served for many years on the faculty there. He's an expert in dairy markets and policy, both regionally, nationally, and internationally. And along with a number of other dairy economists, he runs an excellent website that's called Dairy Markets and Policy. That's at dairymarkets.org. I would encourage any of you to check it out if you're interested in dairy markets policy. Particularly, they have an insightful analysis of the USDA risk management programs there. So without further ado, I'll turn it over to Mark and let him give his presentation.
Well, thank you, Chris, and thank you for having me back again this year. Happy to talk a little bit about the dairy situation and outlook for 2019. I think that I've got a bit more upbeat message than I had last year, and I was sorry to have to give last year's message. And I wish, I guess, in summary, that I could be a bit more upbeat about 2019, but I think we still have a few things that are looming that are going to cause this to be yet a slow recovery. But let's go ahead and talk about it, and I'll try to substantiate some of the ideas that I have. One of the very first things that I do want to talk about is going to be the general economy. Our economy has been in recovery since the recession of 2009. You can see that one measure is the unemployment rate. We hit 10% back in 2009, an extremely high level for us, but we've clawed our way back down and down to a level that most economists would consider certainly to be full employment. And the last 3 months that we had reporting data for, it's been at 3.7%. This is very low and is an indicator that anybody that really wants a job probably has an opportunity for that. And in fact, I know in talking with a lot of businesses that have been looking for employees, it is a difficult task to try to find employees right now. So the economy has been strong, but I wanted to talk about a couple of other measures of the economy that I think give us a little hint or look at the period that we may have coming up here and ahead. There are two measures that I don't normally talk about here, but I do like to look at from time to time. One of them in the blue line is this percentage of household wealth to income. And the idea behind this particular measure is that you look at the asset values that individuals are holding, and those can be things like real estate or automobiles, or certainly portfolios of investments that you may have, stocks, bonds, that type of thing. And anytime that value of household wealth in relationship to the income that people are earning gets to be very large, it's starting to say that not everybody is sharing in the recovery. And we certainly see that kind of thing happening now. That has usually been a precursor of recessions. The other measure that I'm showing here in the brown line is a U.S. Treasury rate for 10-year bonds relative to 2-year rates, 2-year bonds. And the economy likes to have optimism about the future. And when that's true, those 10-year rates tend to be high relative to the short-term rate. And if the inverse is true, that happens occasionally when 2-year rates are actually higher than long-term rates, or as long-term rates values start to decline, they get closer to 2-year rates, then you begin to see that people don't have as much optimism about the future. These two measures have presaged previous recessions that we've had. You'll notice that gray vertical bar in about 2001, and certainly the wider gray bar that we had in 2008 and 9. Those are indicating the time periods when technically we were in recession. And you'll see that both of these measures hit a bottom and we're starting to come back up just prior to recessions happening. I say that because if you look clear over on the right-hand side of this graph, you'll notice that we have both of these measures in strong decline and getting quite low to historic measures. The forecast in the dots there is showing what the Fed is thinking the future may hold for some of these, and it looks as though that household wealth to income, they're forecasting to start coming back up. Again, quite often a predeterminant of recession. I don't want to hold this too much to be negative, but we are seeing some of those kinds of measures in other economies, such as European Union. They are not technically in recession at this point in time, but major countries of the EU like Germany and France and Italy all have measures such as the rate of industrial construction or products that are being built that are in negative territory. So they're producing less of these products than they have in the past. And when that happens, that's oftentimes also a precursor to being in recession. Plus, today is a very important date for England as they look at a Brexit vote. And perhaps depending on what happens there, we could see some rather major things begin to go into tailspin. Also, of course, we have other huge economies like China's, which have certainly been in downturn. It's not recession by any measure, and in fact, their gross domestic product growth is enviable comparison to ours, but it's well down from where they've been in the past decade or two. They had been in ranges of 8, 10, 12% for some years, and currently they're down around 6%. So their growth rate has slowed rather significantly. I've shown this kind of graph before, and I use it because I think it relates more closely to dairy. And this is a chart of consumer confidence, a survey that's done monthly, and the red line is the actual consumer confidence line, but it is an average of the other two lines that we see there. One of those is the present situation, that's in blue, and the other is expectations about a future confident in the economy. That's in the green line. Prior to our recession of 2009, those were all strong, but we saw that the deviation in 2006, 7, and 8 was that the present situation was much higher than expectations. So consumers were happy with the present, but concerned about the future. And when they are in that kind of circumstance, they'll quite often begin to spend less. They get conservative because they're concerned. And in an economy like ours, that will send the general economy into a tailspin, as we saw with our recession. We begin to pull out of that, and we've had a strong economy. In fact, if you look at that blue line, the present situation, it is a remarkable climb forward. But we're beginning to get into that zone where we're quite deviant from our expectations about the future. So we're starting to feel nervous. And this means that we may see some dampening of consumer expenditures. That's the kind of thing that happens, and I would say that it's certainly not being helped by the furloughs that we see with federal employees, and that's beginning to already have some spillover effects into other parts of our economy. I hope that this isn't pushing us into a recession, but we need to be thinking about the preparation for it. This is the last chart that I wanted to point out, I guess, with general economy. This is showing the percentage of gross domestic product, our measure of the economic well-being, that is made up of consumption. So if you look clear over on the left-hand side, you see that the U.S. is the highest of the developed countries in terms of consumption, forming 71% of our gross domestic product here. Now, there's nothing that's inherently right or wrong about having a strong amount of consumption as a percent of GDP, but it does mean that consumption is really important for us. So we want to make sure that we're continuing to buy things and consume them if we are going to have a strong economy or a strong gross domestic product. Clear over on the right-hand side, you see the opposite sort of thing with China. China has a relatively low percentage of consumption. About a third of their economy is based on consumption, and much of the rest of it that's there is based on investment. So that is a country where investment makes up a huge proportion of their economy. Not so for us. And it does leave us a bit more vulnerable to what happens when consumption declines. I bring this up because I do want to focus this a little bit on trade, the importance of trade. This graph is a little busy. It has two different series on it, but on the left-hand axis, measured as a percent of milk production, you can see in the blue line exports. That's been on an increase over quite a long period of time, since about 2004 or 5. We've steadily been working our way up. Prior to that, it was 3.5%, 4%, something like that, for a long period of time. But consumption has grown and has allowed us to sell much more milk into the marketplace as exports. But I want to highlight the right-hand side, where I'm also showing the U.S. All milk price in orange, and you can see that that's got a lot of variation on it. But I point this out because I want to draw your attention to major time periods when we've had downturns in this U.S. all milk price. It was true in that 2002 to 4 time period, 2006, 2009, 12, and more recently, the time period that we're in. And if you look up above at that exports line, you'll notice that this corresponds in every single case to a time when we are off trend with our expectations for exports. So if we aren't exporting as much dairy product for whatever reason, it does tend to back up into our marketplace and has to be cleared on domestic markets. And when that happens, we see this big decline in U.S. all milk prices. So our exports are critically important to our price outlook. If you focus just a little bit on that 2009 time period, when we went from, something like a $22 milk price, all milk price, down to an all milk price that was below $12, that was a 50% decline in milk prices. It was huge. That happened during about a 2% decline in exports. So 2%, may not sound like a very big number, but it is a big number because that product stayed here at home and we had to clear it in our marketplace, which, if you remember from the previous slides, was also in recession. And when our markets were in recession, we had to drop milk prices and dairy product prices to very low levels to clear the marketplace. If you look at our current time period and this long trough that we've been going through, we've also had about a 2% decline in exports. And during that time period, our prices have fallen quite a long way, but not by 50%. So they've dropped by quite a bit, but not the full amount. You'll notice that our exports are beginning to increase. And I should also say one important thing. These export numbers that I'm showing you here are shown as a rolling 12-month average of exports. So it's not getting the up and down variation of a single month. We've actually had months recently that have been up around 18% of our milk production that's been exported. So that's been good, but that hasn't been fully incorporated into our rolling 12-month average yet. And I'm going to just go so far as to forecast that until we achieve something like an 18% rolling 12-month average of exports here, we probably are not going to be back to full milk price recovery in a time period that feels like we can really breathe again. We're working our way toward it, but we aren't there yet. When these products stay at home, one thing that often happens is that they begin to back up into stocks of storable dairy products. Cheese is one of those products that we see. If you look at 2015, the beginning of this time period, downturn in prices, you can see that cheese stocks did not have a normal seasonal pattern of building up during the flush season of the year, April, May, June, and draw down on through the fall of the year. But they were increasing over that entire year. In 2016, they stayed relatively flat, but at higher levels than before. At 2017, we finally saw a more normal pattern, but the stock levels themselves were quite high. And this year, we've seen a relatively high stock levels, but in the last 3 or 4 months, we have seen those stocks actually increasing during a period of the year when they're normally being pulled down. So that's been the reason that we've taken this extra hit in milk prices recently, and it's pummeled our class 3 prices back down. Cheese stocks are at the point that they're a little burdensome for us, and they are pushing down on optimism of class 3 prices. When you take a look at these milk prices, this again is the U.S. all milk price, you'll notice that since January of 2015 and right through the current time, we've really been in this $16 to $18 all milk price range. We haven't broken out of that. We've been up a little bit in 2017 and declined again in 2018. So we're having a hard time getting out of this range-bound territory that we've had. And what we really want to know is, when are we going to be back at $20 to $22 milk prices instead of the $16 to $18 milk prices? A real question has been, why is this trough persisted? You have data from the Northeast and New York, certainly, both at Farm Credit and with the Dairy Farm Business Summary, but I'm grabbing what's been convenient for me to get here in Wisconsin, and that's some data on dairy farms that we have, financial data. And, you know, in looking at this, that graphic that we had on the right-hand side is showing you the kind of range that we see every year in net farm income from operations. So that's cash costs subtracted from the cash milk price. And it's very similar when we look at just the cash costs of production, not net from milk prices, but there is a $10 range every year in this cash cost of production. And that leads us up to the answer, I think, as to why we haven't declined. 2009 was such a severe price trough that we went through that virtually nobody was cash flowing through it. This time, we've actually had groups of farms that have cash flowed through this trough just fine. Maybe 20% of our Wisconsin farms have cash flowed through this. It hasn't been as much fun, but they haven't had to borrow any additional money either. About 30% of our farms in Wisconsin have had to borrow a little bit more, but they're credit worthy, and that hasn't been a big problem. Maybe another 30% have had to restructure loans along the way to push some of the lending off into more long-term payback, even though they may be more like operating expenses that they've been purchasing. And another 20% of our farms, I would say, are in real financial trouble. They perhaps never really recovered from 2009, and now they're in a position where it's going to be difficult to lend money to them. So we've seen quite a bit, and I've talked with some folks in other parts of the country. Can't specifically say for New York or the Northeast, but you know, I wouldn't be surprised if this kind of breakout summarized the farms that we see in the Northeast as well. Again, New York doesn't offer these kind of numbers, but on a monthly basis here in Wisconsin, we can see licensed dairy herds. And this is not headline news that farm numbers are declining. That happens every year and has since 1930. But if you look at those bottom two lines of 2017 and 18, I think you can see that they look a little more divergent than the other ones do. We're losing farms at a more rapid clip. And in fact, we can look at this same data as a percent of farm loss or attrition rate, and that's what I'm showing here. In Wisconsin, it's ordinary for us to lose between 3.5% and 4% of farms, as we did in 2015 and 16. But partway through 2017, that rate began to pick up, and today we're now losing about 7.5% of dairy farms. So this is a doubling of our normal rates of farm loss. Not all of these are from financial stress. Many of them are stage of life issues where it simply doesn't make sense for farms to borrow against their equity in retirement because they won't have time to pay it back and they're leaving the industry. But some of them are because they simply can't secure lending to go through the next year or two. So let's look at this on a broader scale and say, why the long trough out here? Well, here I'm looking outside of the US, but I've included the US in here. This is change in milk production from your earlier levels. The red line is showing you the US. We're pretty steady. In fact, we had been higher back in 2016, a little over 2%. Now we're down in the 1% or even below that in some months. So our increases in milk production have moderated but have not gone negative. You'll also notice that other countries, like the blue line showing the European Union, have been much more volatile than our milk production numbers are. Some months they've been up 5–6%, and if you go back even further, 2015, the European Union was coming out of their long-standing quotas, and they had a big surge in milk production. That put a lot more product on world markets and was competing strongly with what we were trying to sell as an exporter. U.S. is the third largest exporter behind the European Union and New Zealand. The green line is showing you New Zealand. They are much more involved with production risk. If they get adequate rains, but not too much, they can increase milk production a great deal. If it's dry there in New Zealand and pastures are brown, or if they're too wet, they can suffer production losses. And you'll notice perhaps out here in 2018, New Zealand has had a strong start to their production season this year, and they've been making a lot of milk. But the European Union is coming off a severe drought, and they've had pretty severe financial impacts and decisions about how much milk they're producing. They're just essentially at no growth whatsoever. That dashed black line is showing you all major exporters. And I think the good news is that from 2017, it's declined from about a high of 4% to something now more like 1% increase. So that we're slowing down milk production on world markets is going to help us clear the marketplace. In the US, our cow numbers are finally declining. You'll see here that in 2015 they were flat, they grew through 2016 and 17, and finally in 2018 we're finally working down cow numbers. We're down about 30,000 cows in the US herd from where we were back at the beginning of the year. And I expect this decline will continue. This is also putting more animals on the cull cow market, and cow prices are responding to this. Cow prices, at least in our part of the country, are not much better than cull beef prices. The milk per cow per day is the other part of the equation now, and that's continued to grow and at a very normal rate across the US. Seasonal pattern here, but the increase in milk productivity, production of milk per cow, is big enough that even with our cow number declines, we're still increasing total milk production by a little bit. And here is what that graph shows, percent change in milk production. Pretty ordinary for us to be in the 1 to 2% increase, but there's a lot of volatility around that, sometimes much higher, sometimes lower. But since 2017, for a full 2 years now, our rate of increase in milk production has been declining. So those last 2 years, some zigzags, but you'll see that we are moving toward less milk production, and that I think gives us some hope for price recovery as well. Regional shifts in milk production have been occurring. This map is showing you percent change in milk production over a 3-year time period. This compares 2017 to 2015. And during this time period, we had strong increases in production from, say, 3 of our top 5 states at any rate. Wisconsin, Michigan, and New York had strong increases in milk production. So even states like Pennsylvania had an increase in milk production. It wasn't as strong, but it was an increase in Vermont as well. So when those states of the Northeast are increasing milk production like that, we're having to deal with that. Part of the good news is that relatively deficit markets in the Southeast continue to lose milk production, and we can find some sales opportunities down there. But in the far West, California is the #1 milk producing state, lost milk production. And their loss of 2% in milk production is quite a volume of milk. But the real growth over this time period has been from Arizona to Texas, and in that diagonal band on up to North Dakota and on through New York. But let's look at what we've seen in the last 3 quarters at least of 2018 compared to 2017. That Midwest through Northeast growth has really slowed down. We're still positive in Wisconsin, but Michigan and New York and Pennsylvania have all moved to slight negatives, and that whole Southeast is still strongly negative. On the other hand, the far West, California has moved from down 2% to being up actually about 1%. Texas continues to grow. So there's been some shifting in regional patterns of production, and that's impacted the pressure that we've had on milk price premiums over the federal order minimums. Part of the good news is that these dairy products have been a good buy for consumers. The Bureau of Labor Statistics surveys all dairy products, and this is showing you that they peaked for consumers at retail in 2014, and since that time, with our high milk prices then, and since that time period, they've been in decline. Not moving down rapidly, but they are moving down. So dairy consumers are buying dairy products and feeling pretty good about that. But it hasn't been an even story across all dairy products. This is getting to be an old story for us, unfortunately. Fluid milk sales continue to slide. On a per capita basis, we've been losing fluid milk sales, since back in the 1960s. But it held its own during the total sales, at least, and up until about 2010. But since that time period, it's not just per capita that's declining, it's total fluid milk sales. Beverage milk sales are really embroiled in a battle for beverage space in the retail store and consumers' minds. But it's not all bad news. If you take a look at cheese consumption, this is on a per capita basis. Of course, population's continuing to grow too, but we have moved from about 14 pounds of cheese consumption per capita in 1970 to more than 37 pounds of cheese consumption per capita in 2017. So we are, as somebody put it recently, we're eating our milk now. We aren't drinking our milk. And if you take a look at all dairy products, the per capita consumption continues to increase. So it's category shifting away from beverage and more toward manufactured dairy products. It's not all bad news. And just this morning, we had another report on the Global Dairy Trade Index. This is an auction of dairy products that happens every other week. It is sponsored by New Zealand, and there's a known quantity of dairy products that are brought to the marketplace, and the auction begins and repeats until those quantities are just exhausted. In other words, completely sold. And it gives us a pretty good idea about what the world is thinking about the value of dairy products. And you can see here the depression that we've had since 2013 and 14 when the Global Dairy Trade Index was high. 2015-16, it was quite low, recovered some in 2017 and plateaued, tapered off again in 2018. But now the last 4 trading sessions, we've seen some increases here. Now, I guess I would ask you, like that TV show's name, Curb Your Enthusiasm, because we've had upticks like this before, and you can see that in this chart, only to be clobbered again with a downturn in prices. But I think that there's some reason to believe that this recovery right now begins to have legs. So I'm expecting that this is going to continue. And, you know, why do I say that? I say that because part of the problem we've had with the global dairy trade index and world prices for dairy products have been the stocks that have overhung the marketplace. The European Union had a program that was very similar to the U.S. Program, dairy price support program, when they would buy products off the marketplace to provide lift to a general milk price. And that was occurring in the European Union in 2015 and 16. They accumulated a huge amount of skim milk powder in a very short period of time. But this last year, for about half of 2018 anyway, we've been pulling those stocks out pretty quickly, and they're being dispersed through the marketplace. I read not too long ago that the EU is anticipating that they may have these stocks essentially at zero. In other words, no carryover intervention stocks by the end of the first quarter of 2019. I think that's a bit optimistic, but certainly as we get on through 2018 or 19, I think we will see that these stocks are gone. And at that point in time, there's an opportunity for some real price recovery to occur. So this is another positive note. Despite a lot of the trade tensions we've had in headlines lately, I think there's also some room for optimism. China, as a good example, only has about 23 pounds of milk equivalent per capita dairy consumption, and that is small relative to a world average of about 111. And even here in the US, our average is about 640 pounds. And we don't consume as much as some other countries like Greece and France and Germany does. So 23 pounds is almost lost in the decimal points. They're going to continue to grow in consumption, even though their economy is a bit challenged. Recently, the last couple of years, they've been losing more of their small dairies and at a faster rate than their mid-size and large dairies are growing. So their milk production has actually been in contraction. Historically, they've purchased a lot of our whey products. The U.S. is the largest whey producer in the world. We produce about half of the world's whey, and China actually consumes about half of the world's whey. So even though we've got stubborn leaders and they're being slow at renegotiating these trade deals, China and the U.S. can't ignore each other if they are going to consume whey. So it's going to have to come from us at some point in time. We've recently had a trade agreement signed into by our leaders of the country, and that's the U.S., Mexico, and Canada agreement. And that agreement has a small amount of optimism with improved access to Canada. But again, here I would say curb your enthusiasm. It doesn't really provide a lot of additional access for us, but it's a small positive. And with regard to Mexico, it at least gets us back to where we were, with Mexico as essentially having free trade. And Mexico, despite the fact that we still have retaliatory tariffs based on our steel and aluminum tariffs, Mexico has started to purchase some product again. I've got 3 graphs here that have been taken from the U.S. Dairy Export Council website. The first one is showing the most recent change in volume of skim milk powder. The top graph purchased by various countries, and that was for the month of October. Mexico, as you can see, has increased a lot from the same month a year earlier. So too is Southeast Asia. So we're selling quite a bit of powder right now, and that's been supportive of powder prices and thus Class 4 prices. Cheese exports have also been up to Mexico, a little bit to South Korea and a couple of other countries like the Middle East and North Africa. but cheese still has a way to go. But when you look at our whey exports, as I mentioned, China is a huge buyer in the world of whey, and we're a huge provider of whey. And our sales to China in the month of October compared to that same month a year earlier are essentially half of what they were. So it hasn't gone to zero, but it is way diminished. The alternative to producing milk is culling cows, and I showed you in that graph of cow numbers that we are culling animals. Unfortunately, our cull cow price is pretty low as well. We hit a peak back in 2014, and ironically, that's when milk prices are really high and we didn't want to cull cows. And when cull cow prices are low and we want to cull them, we don't have all the incentives in the cow price, but we're culling them anyway. So let's just think about a couple of other factors. The trade retaliation has certainly had an impact on milk prices. And here I would say that our modeling efforts have suggested that the real impact out there should be something more like 50 to 75 cents per hundredweight, as the world would reconfigure who our trading partners would be with those retaliatory tariffs from some countries. But that's a bit frictional, and it takes a while for that to happen. And the truth is that perception becomes reality. Our futures markets lost anywhere from $1.50 to $2 a hundredweight almost overnight. As soon as those tariffs were put in place, people expected that that was going to be what the impact would be. And when those futures markets started to look like that, our spot prices began to look like that for dairy products. And when the spot prices looked like that, that got captured in the contract sales and in our survey of dairy product prices. And that really hit our milk prices at the farm level. The trade mitigation payments that we have and will receive are pretty trivial. It's a small amount on impacted milk, and it doesn't come close to what was actually probably lost as a result of the trade retaliation. But MPP was good news last year. That will have paid almost 62 cents per hundredweight on the first 5 million pounds of historic production if you bought up at the $8 level, and almost everybody did. That was just an obvious thing to do, because by the time you could sign up for it last year, we already had our premium payments in the bank, so to speak. We've got a new dairy product out there, dairy revenue protection product. Right now, there's about 11 billion pounds that are under endorsements out there. But while that's optimistic, I think, and people are beginning to use it and getting a sense for what it is and can do, it can only undergird what the futures markets expect. So if there isn't positive sentiment in the marketplace, then you aren't going to get those kind of prices that you may want or need. But this new product or the changes to the old MPP program, rebranded as the Dairy Margin Coverage Program, I think looks really promising, especially for smaller producers. You can buy all the way up to $9.50, and it's inexpensive. And I would encourage all of the producers, even large producers, to go out and take a look at this, because even for large producers, there are opportunities to skip having to put additional milk into that tier 2 prices out there, or maybe very little milk in that. So here's my price forecast. We're down to that. I'm expecting that this is going to be a recovery year, and you'll notice that in the dashed blue line, I'm showing you class 3 milk prices recovering at a more rapid rate than class 4 is, but we are at a point in time that's a bit unusual but not unheard of, where class 4 prices are higher than class 3, and they will continue to grow as well, but not at as fast a rate as the class 3 prices. This also leads me to an increased expectation for all milk prices, and I'll give you my interpretation here in words in just a second. But there are some other factors that are impacting my price forecasts. Positive factors, I think, include slowing U.S. and world milk production. declining world stocks, those intervention stocks we were talking about, relatively strong domestic economy here in the U.S., and trade improvements are starting to take place. We've also got an El Nino that is formed at this point in time, and I'll talk about that a couple slides later, but that has some likelihood of maybe slowing milk production. So if it does manage to slow milk production, that contributes to a positive price outlook. On the negative side, New Zealand milk production has been strong, and the slow GDP growth in countries like China and maybe the EU can also put some downward pressure on milk sales or dairy product sales. These prolonged trade negotiations, despite the sagacity of tweets, are not easy to win, and in fact, mostly what we have are losers out of this thing. So maybe in the long run we'll be in a better position, but they are certainly hurting dairy trade right now and at this point in time. And we also have this looming possibility of a U.S. recession. I'm not trying to predict that that's going to happen, but boy, we've got a lot of signs that are pointing toward that. And if we have a lot of milk production and a lot of dairy products on the marketplace, that can have a strong negative impact on our price forecast for the year. Here's the El Nino. As I mentioned, it has formed. It's this large warm body of water in the Pacific, and it impacts weather patterns across the U.S. and other countries of the world. For the U.S., the expectation is that we'd have much warmer temperatures in the Northwest and even on through the Midwest and the Northeast. Southeast relatively unimpacted by temperature changes out there. We've certainly seen that this year here in the upper Midwest. It's been mild winter, not particularly cold, and I suspect the Northeast has seen that as well. As far as precipitation goes, not a big impact in the Northeast, but the southeastern states can have much more rain than normal, and regions, milk-producing regions like Wisconsin, Michigan, can have less rain. That's not a big problem for us. In fact, it's kind of a positive. We've had a very wet fall and are carrying a lot of subsoil moisture forward. What actually happens with an El Nino, though, on the other side of the Pacific is important to milk production in the world. Australia is usually one of the first places that gets excessive heat and dryness accompanying that. They've been having that this year already. Extremely dry. Fire dangers are high there. New Zealand so far has not had much in the way of that drought, but it may continue to evolve. And if it does, then we could look at another major exporter not selling as much milk or dairy product into world markets. So here's my forecast. Unless circumstances change significantly out here on the export side, I think it's hard to be overly optimistic about milk prices, but they are going to improve. I don't think they're going to feel really what we might call good until they represent 17 to 18% of milk production on that rolling 12-month average. That's what it's going to take to get us back into that $20 to $22 range on all milk price. Really what I'm forecasting is that Class 3 will be up a little over $1, Class 4 up by more than that, maybe as much as $1.80, and the all milk price up by about $1.15. And that all milk price reflects some weaker premiums in many milk producing regions of the country. California, oddly enough, has had some stronger premiums out there, but through the Northeast and all through the Midwest, we've been having a lot of downward pressure on those premiums. Basically, I think 2019 is going to feel, well, a little bit like 2017, but maybe not quite as good as that. We're losing more farms this year, but we aren't losing our capacity to produce milk, and that's shown by, still having growth in milk production, although it's moderating. And, a question I might just pose is whether this becomes kind of a new normal environment for us. I say that because, this year, I think is not going to look like we've just been on trend. I think this starts to look like our trend line has a little kink in it, and that this is definitely different. I'm not sure that the dairy industry comes out of here and feels like it did before this. This is not an ordinary downturn that we're in. It's persistent. It is changing the way a number of producers are operating and thinking about their future, and perhaps even making them more cautious. But that's still my forecast. And with that, I would be happy to take some questions if we've got a little bit of time and people have them.
Hi, Mark. Thanks. Yeah, we have a few questions that have come in. One, and I'm not sure if you would know the answer to this or not. If not, that's certainly fine. But regarding the shutdown, obviously it's affected USDA offices, Farm Service Agency offices. You can't sign up for FSA programs at this time, that kind of thing. But do you think it's having an impact on exports and like export programs and assistance as well?
I think it's starting to, and the reason I say that is that, I'll just give you an example. The relatively new insurance program, Dairy RP, has trading that occurs on every business day for anybody that wants to buy the insurance products, except days when we have a milk production report coming out, cold storage report coming out, and one other report. Which one is it? I don't remember. Oh, dairy products report. So those three reports. And the reason that they don't sell that product on those days is that those are important products helping dairy markets form their opinions about future prices. And we aren't having those reports published now because they aren't collecting data during this time period. They certainly aren't manufacturing the reports. And to the extent that this is impacting our feedback and information about where dairy products are, this impacts not only U.S. milk prices and price formulation, but a lot of the world comes here looking for these cues as well. So I think it is having an impact, and it may have more if this continues. As far as exports go, could be a problem. Certainly inspections can be a problem. I did notice where FDA is going to begin inspecting dairy products again, because they're one of those products that they feel can be at risk and should be inspected.
Okay. Another good question came in. The new milk marketing order in California, has that impacted other parts of the country, and do you think it will?
Sure. I mean, anything that happens with the #1 milk producing state can have an impact, a ripple effect throughout the country. When the co-ops in the West were originally talking about implementing a federal milk marketing order in the state that had a large state order, they were talking about having something like a $2 impact on milk prices simply by going from the state order to the federal order pricing. And in the work that I had done with some colleagues, we did not expect anything like a $2 milk price impact. We expected something like 50 to 75 cents maybe at the most, and maybe even a little less than that. And I think that's actually what we've seen, that the impact on those milk prices in California has been modest, but a positive for them. And I think it's not likely to be the reason that we've got an increase in milk production happening out there right now. I think that what's happening is that California has been impacted by so many things, including transitioning of those dairy farms from wanting to have a more complete and balanced portfolio of assets. And there is tremendous amount of investment that's been made in nut trees and things in that state, and giving up land that used to produce alfalfa. So the state is clearly slowing down its milk production. And I think that the federal order out there is not the biggest impact that we're seeing. It's a relatively small impact.
Okay. A few good questions here. In the Northeast, it seems unlikely that we're going to reverse the decline in beverage milk consumption that's always provided some kind of premium price level to us. Do you think Northeast processors and producers can innovate away from fluid milk into more processed products and still compete with other areas of the country?
Well, I do absolutely believe that they not only can but will. And I think that if I look just a little bit around the country and where are your opportunities, boy, you've got New York and Pennsylvania and Vermont that are the surplus states of that whole northeastern region. The entire region is 6 to 7 billion pounds of milk net deficit. So you don't produce enough for your own needs right now. And you're right there on the border with the Southeast that is more than 40 billion pounds of milk net deficit annually. I think the Southeast is the place where you'll be producing dairy products for, and it's likely, in my opinion, to be soft dairy products. So the Southeast is so net deficit, and you've got a lot of strength in soft dairy product production that those just seem like a natural opportunity for Northeastern milk producers.
Great. What do you think about the cost side of the margin equation for 2019? Things like feed, fertilizer, and fuel.
Good questions. Well, fuel prices have been really very low. We're certainly seeing them at the gas pump, and I expect that will continue through the rest of the year, for some period of time. Interest rates are one of the places where we're going to see some climbs, and that's going to be an additional cost, particularly for those farms that have had to have additional borrowings over the last year or two. You might really want to watch that pretty closely. Feed costs, I expect, are going to be relatively low. They've been down in the $7 per hundredweight kind of range for a period of time. We've got ample supplies of corn and soybeans already in storage, and unless trade really opens up and we have an opportunity to sell a lot of those coarse grains, I think feed prices are going to remain low. Right now, we have a shortage of dairy quality alfalfa hay, but that's mostly because we had a poor year last year. And, I'm not sure that we can count on having a poor year for that hay again next year.
Okay. Of the farms that you're seeing exiting the industry, going out of business or consolidating, what's the average size that you see doing that? Is it a range of sizes, or is it concentrated mostly in smaller farms? What do you think?
It's concentrated right now mostly in smaller farms, but it's not exclusive to them. We've begun to see more of our, I would say, mid-size farm, on up to that 5, 6, 7, 800 cow size range that are increasingly under financial stress. Many of those farms are the ones who had a son or daughter coming back. They made a fairly heavy investment to increase the size of the operation. And boy, I'll tell you, this was a tough time to do that. And a number of those farms have. If they haven't got all of their production queues underfoot, right now, and they've got the additional burden of, debt to be servicing, then those farms are in a bit of trouble. So most of what we've seen in the way of farm numbers going out have been smaller farms and stage of life operations, but we're starting to see that roll up into the mid-sized farms as well.
Okay. I know that the focus of this outlook is on the conventional milk market, but do you have any thoughts on the organic milk market and the outlook there?
A little bit. I think what we've seen over the last couple of years is that organic milk has graduated from being a niche to being a little bigger than a niche. And when that happens, you begin to see that even a product that has differentiation from our conventional can be commoditized, which is to say we can start to produce more than we have markets for. And we've had a lot of growth in that organic production coming out of Texas and the southern regions of the country. And that milk has put enough pressure on those those market spaces that we're having a difficult time really finding a recovery there. Those segments have also had problems, of course, forever with balancing milk production needs, and I think that continues to be an issue for them. So they're going to have some additional difficulties on going through this next year, much like conventional farms. It's not a safe haven anymore.
Okay. Do you have any thoughts, and I'll give you a couple of thoughts from the Dairy Farm Summary here in the Northeast, about economies of scale and cost of production on large dairy farms, 1,000 to even as much as 5,000 cows versus smaller dairy farms. In the Northeast Dairy Farm Summary, we do see a pretty steady correlation between size of farm and profitability, but it's not a guaranteed correlation, if you will. We find that there are top profit farms in every size group, if you will. I don't know what your thoughts are on the economies of scale and cost of production on some of these larger farms.
Well, we're certainly seeing the same thing out here with our data set, Chris, and we have for a long time. It's been interesting, but I think that part of what we see is that you can't become a large dairy farm until you become a very successful smaller farm, and then a very successful mid-sized farm. And so you're transferring a lot of those best management skills, not only of cows, but of people, and finally of your financial assets, all the way up through. And so, I think our best managers have had not only the incentive, but the wherewithal to become bigger. So bigger becomes kind of a self-selection, and it's not just that there are economies of scale. And a good example is we take a look at our farm size slices, and we certainly see what you're talking about, and that is that our larger farms tend to be more profitable than smaller farms do. But if you go into those slices and then say, I want to look at the top decile of dairy farms in each of the farm sizes, from very large to small operations. And what we find there is that costs of production tend to be very similar across all of our farm sizes. So size is not a guarantee of profit. It just, I think, is more reflective of people who have been successful at smaller farm sizes continuing to grow.
What are your thoughts on potential for export growth beyond the traditional areas we focused on, such as Asia, like places like South America and Middle East, North Africa, other areas that we haven't focused on as much?
We're seeing some growth in those opportunity areas. We've had missions for sales going down into South America, or bringing South American buyers up to the U.S. With what they've called reverse missions, to show them the products we produce and the conditions under which they're produced. And we've had some new sales opportunities as a result of that. One of the things that might be a good thing in the long run that comes out of our trade sales is that we've redoubled our efforts to try to find new buyers of dairy products. And if we do that, are successful at that, and then some of our old buyers come back, it's going to be good for the U.S. Dairy industry. So I'm hopeful for that, and I think we do have some opportunities, particularly Middle East, North Africa, additional sales in Southeast Asia and South America are all possibilities for us.
Okay, it's now we're at 1 o'clock, so I'll just ask one last question and then we'll wrap up. Despite I'm kind of consolidating a couple of questions that have come in here. Despite farms exiting at a relatively rapid rate, we're seeing milk production continue to increase. Is this because despite exits, other farms are expanding? And where are we seeing most of this expansion? Is it in the very largest farms, or is it a broad base, do you think?
Well, first of all, I would tell you that our growth in milk production has been modest this past year. And most of what we're seeing is just continued productivity growth in milk per cow. And our farm loss has been yielding the loss in cow numbers that we're seeing, which hasn't been enough to overcome the productivity growth we've seen. That's most of the growth. However, we have seen concrete continuing to be poured in really all regions of the country. There are farms that are profitable, and I will say that if you can afford it, this is a good time to pick up dairy assets. Cows are really inexpensive right now, and I know farms that have bought some cows just because of that. You may be able to acquire, specialty builders for dairy cattle construction sites because they don't have a lot of extra work going on. So you may be able to build facilities for less than you otherwise would have during this downturn. We'll always see some farms that take advantage of low-cost assets like this kind of time period is yielding.
Okay. Well, with that, I think we'll wrap up. I thank you extremely on behalf of Farm Credit East and all our attendees for your outlook. I wish it was better news, but I think it's at least some improvement, which is good. And unless you have any final thoughts, Mark?
I think it is good. It's going to provide us some relief in 2019. And the real optimism that I guess I'd try to leave you with is that look for the second half of the year, the last quarter perhaps. By that time, we may have enough of our world stocks of dairy products worked down, slowness in milk production across the globe. If we haven't stumbled into more general recessions around the world, then I think we've got a real opportunity to find more sales opportunities. So look toward that latter quarter. That's when we can have the real breakout, I think, in prices.